Basically, outlook and more importance is on the portfolio composition of emerging equity and blue chip, because these two funds have figured in Morningstar recommended list of funds. So first, I will like to congratulate you.
Thank you.
Blue chip, and I'm very happy, and so that I can talk to you. So basically, a nifty expectation, growth, and compositions of going ahead with these two funds, portfolio positioning of these two funds.
Sure. So from market perspective, I think while the market has come back despite energy prices being at 110, challenged and consolidated, and market will take a cue from two or three factors. So one being the reversal of global fiscal and monetary policies, which will have an impact on the liquidity and flows, as well as the growth in US at some point in time in second half. That's second is basically what happens to the energy prices as an outcome of this war, because it has stretched. Initially the take was that it will kind of die down faster, because higher energy prices clearly is something that India struggles with, given the amount of energy imports that we have. So it will have its implications for both basically current account deficit and through current account deficit on interest rates and currency, as well as the fiscal deficit and reduction in space for government to actually do capex in near term. So from that perspective, energy prices remains not only from that perspective, even from a micro perspective at earnings level, given that most of the sectors in India are commodity users rather than commodity producers. So for earnings also, it has its own implications. So earnings will have implications from demand perspective. Earnings will have implications from the perspective of margin compression. So, so that's second. And basically third is then how does this translate into earnings? The combination of macro factors, and particularly the energy cost, higher energy cost, and what kind of earnings downgrades we see, because valuations had corrected, they have kind of retraced back a little bit, but it will be very important to see how earnings pan out for this quarter and next, because this quarter probably still there will be less impact of raw material prices, because it will still not be passed through, will not reflect in this quarter number, but next quarter numbers it will reflect. So by next quarter, if the energy prices don't correct back, then you will have earnings cut getting built in. So that remains the worry from at least our perspective. So that's the basically broader market outlook, how we are looking at. So we are more focused on looking at how earnings shape up, because there was clearly a view that India was likely to actually experience credit growth and domestic cyclicals doing well. But with the war...
Yes, so Vasant sir has joined back.
Yes.
Sorry.
No problem. So as I said, basically the corporate earnings, the global macro environment and the energy prices, these three remains the key. And when you look at the combination of these three, they clearly have an impact on the earnings growth if they persist. The hope is within next 2-3 months, it dies down and the energy prices kind of retrace back to some degree. If that happens, of course, there will be no earnings cut. But this is a challenge incrementally that has shown up. In this context, your return should be subdued for calendar year 22, clearly in market. The only, as I said again and again, the only joker in pack is basically if the energy prices retrace back very fast, then both your demand and the margin pressures go away. So that remains a upside risk to market. But otherwise, it looks like it is going to be a consolidation year, probably relatively low return year. Having said that, from a 3 years perspective, and which I think we have discussed this in the past also, that most of the enablers are in place from domestic perspective. So there is not much of a challenge when you look at the domestic economy. The government forex position is extremely good, external environment is good. Most importantly, the corporate and bank balance sheet is very, very strong. I mean, I haven't seen this kind of balance sheet in last 7, 8, 9 years. After 2013, this is the best corporate and banking balance sheets that you are seeing, which is typically a peak for a business cycle. At the margin, they will be getting downgraded. So that's how broadly we are looking at the market.
And now these two funds now.
Yeah.
Blue chip and
emerging.
emerging.
Yeah. So now coming to our fund, how we are positioned, the fund positioning is largely, I mean, till Feb end, and that's what I'll tell you, was basically on the premise that domestic earning cycle is getting upgraded at the cost of external. So if you look at last 18 months, you had exporting sectors who have had earnings upgrade cycle. Our belief was this earnings upgrade cycle was going to get passed on to basically domestic sectors, which is financial, industrial, housing, discretionary, cement, auto, all these segments. And that's where the portfolio was positioned. That thesis, we have not changed that position. We still remained in that position. We just moderated this position post this war because one of the factors that impacts negatively to this thesis on the discretionary and auto and cement side and all these sides is also energy prices. And to that extent, we have more. But the portfolio positioning remains overweight on basically financials, overweight on basically discretionary, overweight on the cement, overweight on housing, and overweight on externally focused sectors. In exports, we're only overweight on IT. IT is the only sector which is overweight on export side.
And what is your advice to investors?
Advice to investors is this year, so don't look at the random movements that are happening in market. They should just focus on actually next 3 years. In the next 3 years, it still looks like the best asset class whereby you'll get a double-digit return in this asset class vis-a-vis most of the other asset classes very easily. But near term, this year is going to be kind of fairly volatile, so that people can actually their investment over next 6-8 months to this year. I don't see a very large return this year anyway, unless until the energy prices come back to 70-80 plus, which is a little difficult task at this point in time.
Thank you, sir. I will share the draft with Darshana, and after you look at and approve, I will get published on Monday.
Done.
Okay. Thanks a lot for joining.
Thank you.
Thank you. Thank you so much.
Thank you.
Thank you.